Hello and welcome. Today we are covering 7 essential tools that help you identify support and resistance levels in real time. We have specifically chosen methods that provide immediate, actionable information, no waiting for lagging indicators. Let's explore them together. Fibonacci tools are among the most popular and effective technical analysis methods. There are numerous Fibonacci-based instruments available, but in today's video we will focus on the most widely used one, which is Fibonacci retracement. This is an exceptionally valuable tool because it doesn't lag behind price action. Instead, it actually predicts where market reactions can be expected before they happen. It determines the precise levels where price could potentially return and from where we can trade reversals to continue the existing trend. We don't trade breakouts or trend flips, but we always focus on trading reversals at key Fibonacci levels. To access this tool, go to the Drawing Tools and navigate to the Fibonacci Extensions section, where you will find Fibonacci retracement. There's also a convenient keyboard shortcut available, which is F8 for quick access. Similar to trend lines, we need to identify significant swing highs and swing lows on the chart. However, unlike trend lines where we connect the same types of points, which means lows with lows and highs with highs, with Fibonacci retracement, we always use one significant high and one significant low, creating a range between these two extreme points. I will consider this swing low as my starting point and this swing high as my ending point. Notice how certain key levels are automatically plotted on the chart where reactions can be statistically expected. These are psychological levels based on extensive market statistics. We are looking at the S&P 500 on a daily chart, which means these aren't random swings, but points derived from one of the most powerful time frames for ES. The Fibonacci retracement is plotted where the starting point represents 100% and the target point represents 0%. In practice, you might also encounter the opposite approach, where some traders plot with the starting point at 0% and the target at 100%. I rather verified the correct plotting method in Fibonacci Analysis book by Constance Brown. When price forms a pullback, it cuts into the original movement between the swing extremes, gradually returning to 23.6% of the total movement, then to 38.2%, and subsequently to 50% of the total swing range. If I were to draw the tool in reverse direction, then the first retracement level would appear at 76.4% because the levels would be drawn in reverse order. The actual price level would be plotted at the same location, since 76.4 is the mathematical complement of 23.6 to 100, but the pullback value itself wouldn't make logical sense. Another extremely important consideration is ensuring that you have the most commonly recognized levels displayed on your chart only. These settings are available in ATAS by default. Observe how the price reached this swing high and created the maximum point of the movement. Notice where the price subsequently returned. It reached practically exactly the 38.2% level. There are probably more myths and supposedly guaranteed trading tips surrounding Fibonacci retracement than any other technical tool, particularly suggesting which magic levels work best. This approaches alchemy or even occultism in trading. Be extremely careful not to fall into this trap with the Fibonacci tool, such as when you have an absurd number of levels plotted and you can't determine which level deserves your focus. In this cluttered form, The tool becomes almost completely unusable. There is no compelling reason to prefer exotic levels like different golden pocket variations, 80.8%, or other wannabe magical values. It's ideal to rely on the most common and statistically frequent levels without doubting their effectiveness. Price reactions at Fibonacci levels vary significantly in their reliability, with deeper retracements generally carrying more significance than shallow ones. The 61.8% level, known as the golden retracement, is considered the most important and influential for signaling potential price reversals, making it more reliable than 23.6% level. A shallow retracement to 38.2% often signals that the trend is strong, as the price pulls back only slightly before continuing in the original direction, while a deeper retracement to 61.8% is considered a Goldilocks level, as it is deep enough to shake out trend traders and offers a great risk-to-reward ratio opportunity if the prevailing trend continues. When price reacts strongly at the 50% level versus the 23.6% level, this tells us about the market psychology and trend strength. A retracement to 50% suggests a moderate correction, which could indicate uncertainty in the trend, giving traders a chance to reassess the market's direction, whereas shallow retracements, such as 38.2% retracement, suggest strong momentum. The reliability hierarchy essentially shows that reactions at deeper levels, such as 50% and 61.8%, indicate more serious testing of the trend and thus provide stronger signals for potential reversals, while reactions at the 23.6% level may simply represent minor profit-taking in an otherwise strong trend. The 38.2% and the 61.8% levels tend to perform better in trading markets, and traders often use confluence with other technical indicators at these levels to confirm the reliability of potential reversal zones. Fibonacci retracement can be successfully applied to any financial instrument and on any time frame. Here we are examining the daily chart of Ethereum to demonstrate this versatility. Let's focus our attention on this prominent swing high and this corresponding swing low that creates our analysis range. We will draw a Fibonacci retracement between these two extremes and analyze how far the pullback extends in terms of the original move. Observe, once again, how beautifully and precisely the price reacted to the 61.8% level on the daily chart of Ethereum. Again, I will adjust the settings so that the percentage labels appear on the right side rather than on the left for better visibility. You can clearly see that the reaction to the 61.8% level was absolutely accurate and reliable. This means that during the downward movement, we were anticipating an upward retracement, and when price reached above the 50% level, we noticed a test of the crucial 61.8% level on the daily time frame. At this point, we could have entered a short position and successfully traded the continuation of the downtrend on the Ethereum daily chart.